give heading in your notes, long-lived assets. Now this is a old reading. It has always been in the curriculum, CFA level 1 curriculum, almost for last 7-8 examinations. But what they've done, they've added 3 to 4 new learning outcomes. And with these new learning outcomes, the level of difficulty is going to be relatively higher compared to what it used to be. Especially they've taken certain learning outcomes from level 2 and they've transferred them to level 1. So I'm going to follow a learning outcome approach, which means we'll be doing one learning outcome at a time. So if you have your notes in front of you, you can keep them so that you would be able to understand what is there and what. If you don't have it, it's perfectly fine. You can just give reference to learning outcome numbers. So the first learning outcome, A, discusses about costs which are capitalized versus the cost which are expensed in the period in which they are incurred. The costs which are capitalized versus the cost which is expensed. This is learning outcome A. So let's understand what they mean by this. Let us say we have a balance sheet. Going to make a very simplistic one. Left hand side we typically write equities and liabilities. So equity of about 1000 and the firm has cash of about 1000. They have decided to make use of this cash. So 200 of this cash was spent towards payment of salary. So when we make payment of salary, can I call this expenditure as an OPEX expenditure? OPEX would be operating expenditure. So what we say is that we have paid this salary because we receive the benefit from the employees in this season. And therefore, this salary is considered to be expensed when incurred. And then what is the treatment we make? So we would say minus 200 from the cash, and this 200 would be shown as an expenditure. And then you would appreciate that any item which goes in to be shown as expenditure eventually reduces equity, it reduces profit, and therefore it reduces equity. So the ultimate impact that we will have on balance sheet, the cash will reduce and indirectly equity will reduce. Do you agree with this? But let us say 800 worth of cash, we decided to purchase PPE, property, plant and equipment. Then what we will say is that this expenditure is in the nature of capex. It is a capital expenditure and therefore this should be capitalized. So once we decide to capitalize, what we would do is 800 will be reduced from cash, but this time it will not go to your income statement. It would be shown on balance sheet directly. We will say PPE 800 and that's how your balance sheet tallies. So when someone talks about some cost being expense, we are essentially referring to the fact that that amount has been shown as an expenditure in your profit and loss account. But if there is a discussion on cost being capitalized, then the same cash has gone out, but now we are thinking that we have purchased an asset from them, so cost is capitalized. Is that clear? Any questions you would like to ask here? Okay. Now, in most of the cases, it's very clear when to capitalize and when to expense. But in certain cases, for example, think of advertisement expenditure. Okay, so let us say a firm has spent, so this is again balance sheet. We have equity of 1000 and we have cash of 1000. A firm has spent 500 towards advertisement expenditure. Now, no matter whether we decide to capitalize or expense it out, 500 is to be reduced from cash. Now, the accountant needs to decide whether this amount to be expensed or this amount to be capitalized. And then what accountant would say is that if it is a one-time large expenditure which is going to help us build a brand and it will help us generate revenue for years to come, if he decides to do that, then it would be considered as a deferred revenue expenditure. That means we will capitalize and then we will say deferred advertisement expenditure 500, it would be shown as an asset on the balance sheet. Do you agree? But if accountant feels that no, it is a regular expenditure, it is a recurring expenditure, this is the amount we spend every year, then he will not capitalize this, but rather it would be shown as an expense in your income statement, and then the second effect, your equity will reduce. And what you can clearly see is that because whether he decides to capitalize or he decides to expense, your numbers on the income statement and balance sheet are going to change drastically. Are you convinced here? Do you want to ask any questions? Okay. So this third part of learning outcome A is what you would want to write down. Interest expenditure during construction period. Interest expenditure during construction period. So let us say we have gone to a bank and we have taken a loan of 100. Interest rate on this loan is 10%, and this loan, it is to be exclusively used for construction of a particular building. So there is a specific purpose attached that the loan would be used for construction of this building. The tenure of the loan is 5 years. So these are your 5 years. This is time 0. This is 1, 2, 3, 4 and 5. Now what happens is this building construction activity is completed in the 3 years itself. So even though the loan was for 5 years, the building construction activity was completed in 3 years. So what the firm will do is, the interest expenditure which is paid here, how much would that be? 10, 10 and 10. All these three amount, firm would decide to capitalize. Capitalize means it would not be shown as an expenditure, it would be added to the cost of the building. Now let us say this company is a real estate company. This company is a real estate company. So tell me now, when we capitalize, where should this interest be added to? PPE. So this interest would be added to inventory of that organization, because real estate for a real estate company is inventory, it is not PPE. Are you following this? It is their business to build those buildings and then sell them. So this 10, 10, 10, it would not be taken to income statement. Rather, it would be simply added to the cost of inventory that we have on the balance sheet. However, this 10 and this 10, interest costs incurred after the construction period, both of these would directly be shown as a expenditure and they would be taken to income statement. Are you fine with this? So costs incurred, interest costs incurred during the construction period is capitalized, but after that it is expensed out. Please write down. Let us do learning outcome B. Learning outcome B is for intangible assets. Now we are going to make a flow chart here. So intangible assets could either be internally developed or they could be acquired in business combination. So we would first do an example of acquisition in business combination. Observe this carefully. Let us say there is a company A being the acquirer. It plans to take over company T, which is the target. So we have a balance sheet here. So on the balance sheet we have equity of, let us say, 1000. We have debt of 1000. We have PPE of 1000, and let's say we have cash of 1000. Now that PPE has a market value, and the market value of this PPE is, let us say, 1500. Now A has decided to acquire entire 100% stake in T. That means it is going to completely take over, and it is decided that it would pay a premium. Let us say the premium paid is, so amount paid is 5000. I'm just making up the number. So A paid to T an amount of 5000 and acquired a 100% stake. So what we calculate is, we first calculate fair value of assets or fair value of net assets. So how will we take that? We will say PPE was worth how much? 1500. Cash was how much? 1000, and we also have to reduce the liability. So we reduce that liability 1000. So net fair value of assets acquired is how much? 1500. Have you understood this? 1500 for PPE, 1000 for cash, and we reduce the liability of 1000. That means we are considering the fair values of the assets, we are not considering book values of the assets. But what was the amount we paid? So how much extra did we pay? 3500. So that 3500 would be referred to as goodwill, and that is referred to as intangible asset acquired in business combination. Is that clear? So you can make the flowchart on the right hand side. You can say fair value of net assets. So that justifies reduction of liability. Now the internally developed side. Here the treatment would differ depending on whether we are in IFRS or we are in US GAAP. So if we are in IFRS, we would classify expenses into two parts: research and development. Same is the case with US GAAP. We will divide expenditure into two parts: research and development, research and development, research and development. In IFRS, research expenditure is expensed when incurred. Research expenditure is expensed when incurred. Okay, so research means, to think of it this way, there are a lot of companies in India which do business in a space called CRAMS. Okay, these are all, so one example could be Suven Pharma from Hyderabad. And what these guys do is that they do contract research for big listed companies. So they are given certain research assignments and they finish those research. Not necessary that research would be successful. So all the amount that you spend on the research, not necessary it would bring you results, so that is to be expensed. But what would be development? So once certain molecule has been tested to be positive, it might bring results. So you know that this molecule has potential and you start to decide this, you start to develop this technologically or commercially. So whatever development cost is incurred, that is to be capitalized. So research expensed, development capitalized. This is in IFRS. US GAAP is slightly more conservative on this front. So research expensed and development is also expensed. So US GAAP does not allow us to capitalize research, neither does it allow us to capitalize development, and the entire amount of it to be expensed when incurred. There is only one exception, so which is except the software development cost. Except software development costs. So in software development there are few ifs and buts depending on what is the purpose of software development. But for level 1 exams, the general rule will be sufficient. So the general rule is that whatever is a research expenditure, so US GAAP does not use the word research, they say till the time technological feasibility is established, which is similar to research. You don't know whether it would be put to use, but you're trying to figure out whether we can really have some technological use out of it. So all the research expenditure is expensed, and all expenditure after that, so let me call that as development, all expenditure after that is to be capitalized. So which means the software development cost is similar to what otherwise it would be treated in IFRS, where we expense the research, we capitalize the development cost. Yeah, so for software development, there are different scenarios in terms of what is the purpose for which the software is developed, whether we have developed for selling the software or we have developed for in-house use. But you just remember this generic thing. We don't really need to get into those nitty-gritties. Are we good to go ahead now? All these intangible assets, which is, let us say, patents or copyrights or softwares, all these intangible assets are amortized like any other asset. So every year there would be an amortization charge which will reduce the value of assets. Whereas goodwill, which is acquired in a business combination, is never amortized. Goodwill is never amortized. Rather, it is tested for impairment. Yes. Checking whether the market value has reduced or the market value is more or less similar. If the market value has reduced and if the reduction is other than temporary, so that's a fancy accounting word, but what it simply says is if the reduction is a permanent reduction, then we will reduce the value of asset from the books. One time reduction, we will call that as impairment losses. Learning outcome C, capitalizing versus expensing, we have to look at impact on ratios. We are going to consider this scenario if capitalized. If capitalized as against, first, what do you think would be impact on profit after tax in the first year? What will happen to profit after tax? It will increase because we did not expense it, we rather showed it as asset. So profit after tax in the first year will increase. What do you think would be the impact on profit after tax for subsequent year? Will that have any impact? Decrease? So because you capitalize in the first year, now you will have an asset. And over the period of time, that asset needs to be depreciated, which means subsequent year, your profit after tax will be lesser. So it will decrease. Have you understood this part? So because you decided to capitalize, first year your expense was substantially lesser compared to expensing scenario, but second year that asset needs to be depreciated, so you will have a depreciation, but expensing will not have a depreciation, so PAT will be lesser. Scenario 3, what would be the impact on EBIT in the first year? What would be the impact on EBIT in the first year? Will it have no impact or it will increase? EBIT will have no impact because interest expenditure comes after EBIT. Right? So we are deciding whether that interest is to be expensed or capitalized, which means there would be no impact on EBIT. Fourth, what would be the impact on EBIT in the subsequent years? Now it will decrease. Why? Because subsequent years now we will have depreciation, and depreciation is a operating expenditure. Do you want me to explain any of these 4 ratios? Then number 5, what would be the impact on asset turnover ratio? So asset turnover ratio is calculated as sales divided by total assets. And if you capitalize, will that have any impact on sales? No impact on numerator. But because you capitalize, your denominator will increase. And because denominator will increase, the ratio would be decreased. Number 6, what would be the impact on ROA? This is a slightly difficult one. Return on assets, which is calculated as net income. In fact, for this, net income divided by total assets. So here I am going to ignore taxes. Once you consider taxes, it becomes a little difficult. Net income divided by total assets. So now what happens in this ratio is, because you decided to capitalize, your denominator will increase by X. And because you decided to capitalize, compared to expensing, your numerator will also increase by same amount X. So when the both numerator and denominator increases by the same amount, what happens to ratio? It depends on whether the ratio is less than 1 or whether the ratio is more than 1. Net income by total assets is typically less than 1. And if the same amount gets added to numerator and denominator, then this ratio will increase. So I'll give you an example which will make it easier. Let us say the scenario is like this, 50 and 100. And if you add 10 and 10 in both numerator and denominator, then your numerator has increased by 20%, whereas your denominator has increased by 10%. And since your numerator has increased by more in percentage term, we will expect that ratio to go up. So whenever the ratio is less than 1 and you add the same amount to numerator and denominator, ratio increases. When the ratio is more than 1, you add same amount, the ratio decreases. Any of these 6 points you would want me to explain? Had it been inversed, then the ratio would have decreased. See, it's like this. If your ratio is less than 1. So I'll tell you easy memory trick to think of this. So you can imagine some hypothetical numbers. So I generally think of it in this fashion. I keep 50 and 100. If you add the same number to numerator and denominator, then proportionately your numerator is increasing more. So ratio will increase. If you add or if you remove same number from numerator and denominator, then proportionately you're decreasing more from the numerator. So the ratio will decrease. Do you agree? If ratio is more than 1, so this is 100, this is 50. If you add the same number to numerator and denominator, then your denominator is increasing more in percentage term, the ratio will come down. Are you following this? And yes or no? And if you remove the same number from numerator and denominator, then your denominator is decreasing more than proportionately. Now the ratio will increase. So you can just take some numbers and then imagine in percentage term who is increasing or decreasing more, and then decide what will happen to ratio. Is that okay? Fine. Next learning outcome now. This is about depreciation methods. So the first depreciation method is straight line method. Let us say value of an asset. So this is the purchase cost is 100,000. Estimated salvage value. So this is an estimated number. Estimated salvage value is 20,000. And estimated useful life. Again an estimated number, accounting estimates. Estimated useful life is 4 years. So every year your depreciation would be 100,000 minus 20,000 divided by 4. So for each of the 4 years you will charge depreciation of 20,000. Therefore it is called as a straight line method. Are you fine here? Now again what I would want you to appreciate is that you have charged depreciation in such a way that by the end of year 4 the value of asset in your books would be equal to the salvage value, and then you would sell that asset in the market and recover the salvage value. That is the thought process behind charging depreciation up to the salvage value. Is it clear? Second type of method is double declining balance. Double declining balance. So we would simply refer this to as DDB. Let us say value of asset, the acquisition cost is 100,000. Salvage value 20,000 and life is 4 years. So the formula that we use for calculation of double declining balance, the numerator is opening book value. And please notice numerator is not acquisition cost like straight line method, it is opening book value divided by total life, not remaining life, multiplied by 2. So in year 1, the depreciation would be calculated as 100,000 divided by 4 into 2, which is 50,000. Another thing to be observed, the salvage value is not a part of the formula. Then second year, because you have charged depreciation of 50,000 in the first year, your book value is 50,000. So 50,000 divided by 4 into 2, which would be 25,000. Third year, the formula tells us that we should be charging 25 divided by 4 into 2, 12,500. However, if we charge 12,500, then the value of the asset will go less than the salvage value. So how much is the amount remaining? We have charged 75 so far, 50 plus 25. The value of the asset was 100,000. So book value right now is 25. So what we do in year 3 and year 5, we just divide that amount into 2 parts. So excess amount is 2,500 here and excess amount is 2,500 here. So that by the end of year 4, value of the asset in the books would be 20,000, which is equal to the salvage value. Which means total depreciation charged over the period of 4 years is 50 plus 20, 75 plus 2,500 plus 2,500, 80. Do you want me to repeat this again? So you charge 50 in 1 year, 25 in second year as per the formula. When you reached here, your formula for third year is giving you a value more than what is the depreciable amount. What is the depreciable amount here? Depreciable amount is 80,000. So at any point of time, amount of depreciation cannot exceed 80,000, which is 100,000 minus 20,000. So you charge 50 in first year, 25 in second year as per the formula. You're left with 5 of depreciable amount. So you just divided that equally in year 3 and year 4. Salvage value is what is your estimate of at what price you would be able to sell your asset at the end of its life. So it is a scrap value. Yeah, so in practice, when you reach at year 4, you might end up selling this asset at 15 or you might end up selling at 25. And then you'll have to book a profit or loss of 5 accordingly. So that is an estimated salvage value. Third method of depreciation, units of production. Let us say purchase cost 100,000, then estimated salvage value 20,000, and number of units which could be produced is 10,000. And then we've been provided a schedule like this. So schedule of quantity, estimated quantity to be produced. So in year 1 we will produce 2,000, year 2 5,000, then 3,000, this should be 2,000, this should be 1,000. So what we can calculate is what is the depreciable amount per unit. Depreciable amount per unit, how will we calculate that? We will say 100,000 is the value of asset, 20,000 is salvage value, and we can produce total units of 10,000, which means per unit the depreciable amount is 8. If your depreciable amount is 80,000 and if you can produce 10,000 units, per unit depreciable amount is 8. Now if you'd observe this, the total of these has to be 10,000 units. So you would multiply that with the depreciable amount for each of the year. This is multiplied by 8, 8, 8 and 8. So that will give you the amount of depreciation. First year 16,000, second year 40,000, third year 16,000, then 8,000, and total depreciation 80,000. Learning outcome E. So in fact there is a learning outcome F which talks about calculation of different methods of amortization methods. So amortization is the word we use for intangible assets and depreciation for tangible assets. So amortization methods and depreciation methods are same. So when you gave heading of learning outcome D, you can say D and F together. D and F are precisely same. There is no difference between them. So D and F we covered together. Now we are going to cover learning outcome E and G together. E and G, which is about impact of assumptions on ratios. This is learning outcome E and learning outcome G, impact of assumptions on ratios. So while calculating depreciation, tell me which all assumptions do we make? One assumption is we estimated useful life, estimated useful life. Now imagine useful life means for how many years that asset would be put to use. So if you estimate it more than what it really is, so you think that asset would be put to use for 5 years, but for while calculating depreciation you use 10 years, then what would be the impact on your numbers? Number one, your profit will always be overstated, correct, because you're charging less depreciation. Second, because your profits are more, you'd end up paying more taxes. Because you'd end up paying more taxes, your cash will be lesser. Do you agree? Then last, because you're charging less depreciation, your assets would be higher. And because you're charging less depreciation, your equity will be higher. So if estimated useful life is assumed more than what it should be, then profits are more, taxes are more, cash is less, assets is more, equity is more. Second assumption is of salvage value. If you estimate salvage value more than that, more than what it really is, then again you're overstating your profits. Because of overstating of profits, taxes paid are more. Therefore, cash with you is less. Assets with you are more. Automatically, profits are more, so equity is more. Yeah, so in case of intangible asset, there wouldn't be any salvage value.